Good afternoon, everyone. Thank you for joining the this month's coffee hour presentation. This is an introductory presentation on investing with self-directed IRAs with a focus on real estate. And live with us today is Dan Filardo of New Direction Trust Company. Disclaimer is that this presentation is to be provided and comprised of personal viewpoints of the speaker. Thus, HSBA has not approved of nor does it endorse the speaker recommendations. A little bit of background of Dan. Dan has been working with the Hawaiian market since 1992, and his knowledge of Hawaiian business practices and his network of contacts across the state brings an insider's strength to NDTCO's Hawaii office. Dan has a BA in International Relations, a Series 3 Commodity Brokers license, an MBA in e-business, and is a specialist in self-directed investing. Known for being warm, friendly, and full of aloha spirit. And I know that personally because Dan has worked with me. Dan is also a UH certified master gardener and enjoys hiking and beach time with friends. And with that brief description, Dan.
Thank you, Gil.
You're welcome.
Okay. Okay, that was good, just a little bit. There you go, that's good. Am I blocking anything?
No, you're good. Yeah.
Hold on. Help you there.
Okay, down arrow. There you go.
Okay. Well, thank you, Gil. I appreciate the introduction. I'm Dan Filardo with New Direction Trust Company. We are self-directed IRA custodians. Here, been in the Hawaii office for 17 years. I've been out here now for 31 years, so time does fly. We're going to be going over self-directed IRAs. It's an introductory information focusing on real estate because that is the majority of our Hawaii clients, but the clients get to choose what they want to do. We start out by a disclaimer. So we don't sell any products, we don't recommend any products, we don't give any advice. We are the custodians for our clients' self-directed accounts, but when they need legal advice, we refer them to their legal professionals, and when they need tax advice, we refer them to tax professionals. So it's really important to know that as the neutral custodians, we can tell them what they can and cannot do, but never what they should do. So we're not giving advice. When they ask for advice, I send them elsewhere. Okay, so self-directed IRAs, people often say, well, what is it? How does that work? We follow all the same IRS codes as any other qualified retirement account. It's a descriptive term that's different. It's not a legal distinction. So any IRA, whether it's self-directed or not self-directed, follows the same codes. And self-directed portion is really the client is the self of self-direction, meaning that they're choosing the assets that are held in their accounts and nothing they don't want is going to be in there. So they know absolutely what they're wanting to invest in is in there and nothing else. So real estate really is the number one. I brought malasadas back there that are still warm if you want some.
They're really good.
So real estate is really the bread and butter of our industry. We get a lot of questions about, is this legal? Because I haven't heard of this before, and we refer them to irs.gov. In their FAQ section, getting the IRS to endorse or promote anything is really, that's not something they do either. But this is about as far as they'll go on a really great IRA law does not prohibit investing in real estate, but trustees are not required to offer real estate as an option. This just means that Schwab and Fidelity don't do that, right? So if you want it to be self-directed, then you get to choose the investment. So says the FAQ on irs.gov. Now you've probably seen these different types of accounts. We have individual accounts and employer accounts. All of these plans with us are self-directed. So depending on what the client has and what they're going to be doing with it and what they're doing moving forward or where they're going to roll over or transfer, they're probably going to have one of these accounts. The individual plans is the traditional tax deferred. You get the contribution deduction when you make that. The Roth is opposite. So the beauty This gets back to the taxes, right? Which one is better for you? Clients often ask, hey, I've heard I need to do a Roth conversion. Tell me about that. Well, that's really the right answer is what your tax professional tells you as far as what you think it's going to cost you to convert, because the tax deferred account, you're going to pay the taxes later. You're deferring it. The Roth, you've already paid it up front, so it grows tax free. So is it better to have the tax free and pay the conversion tax? That's really a question that's very individual, and the clients will refer to their CPA or whoever does their taxes to give them the advice about that. Most people, when they have an old 401k, it rolls over into a traditional IRA. It stays tax deferred. But there's always, sometimes there's Roth contingencies in 401ks, and they're getting rid of both their Roth and their primary 401k, and it would roll into a traditional and into a Roth IRA. Now, there are employer plans where the SEP IRA is very popular here with our clients. We have a lot of realtors that are independent business owners where they are the employer and the employee, and that is the simplified employee pension plan. So for example, annual contributions for a traditional IRA, when they're putting new money in, not for growth but new money contributions, you're looking about $7,000 a year. That's not a lot of money, but when you have the SEP IRA, which is still the tax deferred traditional IRA plus the employer side of it, it's both the employer and the employee. I think the current year, it ticks up every few years, but I think it's currently $69,000 or 25% of your annual income, whichever is less. So people with high wealth can get a lot of money into their SEPs and have a nice tax deduction for making that contribution. And then they have more money to purchase real estate with. So a lot of realtors, clients of ours, have SEP IRAs, and they have been making a nice living in real estate on the island for a long time, and they have quite a bit of money in their SEPs, and they also know the real estate market because that's their business. So those are really good clients for us. The ones that like real estate, that know the local market and have big SEPs, because they have more options, obviously. The simple and the solo K, these are small business owners, but most of them will fall in, well, they will fall into one of these. And it really depends on where their funds are currently that they're going to be moving over, transferring, or rolling over. Want to make sure it goes into a like kind account so that there's not a taxable transaction of moving those funds. So 4975 is, yeah. Prohibited transactions. We have two main things that we keep our clients on the straight and narrow as much as possible: prohibited transactions and disqualified people. So those are the things we're allowed to talk to them about, what they can and what they can't do as far as prohibited transactions. And selling something that you own to your IRA or from your IRA is a prohibited transaction, because the IRS says you can't sit across from yourself at a negotiations table and make the best deal for your IRA. So there's no self-dealing. If you have a property that you have under title in your name, your IRA cannot buy that. Now, if you have it the other way around, you have a property in your IRA that you want to live in someday, you can do an in-kind distribution. It is a taxable transaction at that point, but sometimes people make that investment to retire into, right? They're going to buy this nice rental property, they're going to rent it out for 10 years, and when they get to a retirement age, they're going to have a lot of rental income from the 10 years, and they know it's going to be a large taxable transaction to do an in-kind distribution out at one time. This is when they're talking to their CPAs, but that would then take it from the IRA asset to a personal asset, and they could do whatever they wanted to it at that point. They could live in it. And I will go over that with the next slide about disqualified people. Just know that it needs to be a new investment, not one that you control, not one that you currently own on title or spouses, but it needs to be a new investment. Lending money, this is when you get a mortgage, they want to see all your assets, right? So this is, you can show your IRA as assets, but you can't pledge your IRA as an asset against the mortgage. Providing services for your IRA, this comes in the real estate world of property management, who's mowing the lawn, those types of things, so. No sweat equity is allowed for this one here, you know. It speaks to itself on there. But just know that you cannot be the paid property manager for the IRA owned unit. Whether you use a property manager or not, that's still your choice, but you can't be the paid one. Personal use of the plan, this one comes up the most in real estate because people are like, hey, that vacation rental that our IRA owns in Waikiki is not being rented this weekend. Can we go stay in it? Well, that is a prohibited transaction because your IRA has not paid the taxes on that property yet in your IRA. Therefore, it qualifies for qualified funds. You have to follow the rules. And one of the rules is no personal use of plan assets. So I tell people, look, when you have $500,000 in mutual funds in your IRA, nobody thinks about staying there on the weekends, right? So it's the same in the eyes of the IRS. This is just another asset in a retirement plan, but that is one that doesn't come up with mutual funds and stocks, but it certainly does come up as a question that people have when it becomes a solid asset or rental property. Fiduciaries, no use of the assets, and getting paid by your IRA goes back to the providing services. So this is probably the best visual I have. This is for disqualified people. So we have the ascendant and descendant family line. So the client is always like, okay, this is my IRA and the spouse. So the ascendant, descendant family line are in red. That means they are disqualified. So no spouses, no parents, no grandparents, children, grandchildren. Exes and steps are okay, just so you know, because that does come up and it's not on the slide. The periphery relatives, the siblings, aunties, uncles, they are non-disqualified. So again, back to IRS way of life, they have disqualified people that are definitely no, and they have non-disqualified people that are these periphery people, but there are no qualified people in the qualified plan. So they just have disqualified and non-disqualified. So that's jargon. Yes, Natalie.
You clarify what disqualified for what?
Yes, I will. That is disqualified from having the previous slide of prohibited transactions. So, let me finish this one first. So, the IRA holder, we're just gonna use round numbers, right? Some people have millions of dollars, some people have hundreds of thousands, some have tens of thousands, right? So for real estate, there's a price point of entry here in Hawaii, and let's just use $1 million. So this account holder has $1 million in his IRA or her IRA, and likes any new Modea, Kuile Place, whatever, you know, properties, could be old, could be pre-construction. They are disqualified from living in that property. Even if they pay market rent, they cannot pay money to their own IRA. That would be a contribution. So they are disqualified from having personal use of plan assets. But these people are okay. Your brother can live in the condo, whether he pays the rent or not, you know. This is supposed to be for your retirement, not because your brother needs a roof over his head, even though he's legally allowed to be the tenant in there. The people in the red are not. So other asset categories, our top 3 assets are real estate, a promissory note, private lending, and private stock. So when it comes to private lending, as a promissory note, the IRA is the lender and the borrower is going to pay interest on that loan. So they negotiate the terms, the lender is the IRA, and the borrower needs to be a non-disqualified person, right? So you cannot lend $100,000 to your daughter from your IRA and call that an asset. That would not be good. It would be a prohibited transaction from a disqualified person. So this is really the one here. Where do people in your lives, and you know, we're neutral, so I don't tell them who the tenant should be, but I can tell them who the tenant cannot be. for sure. But I tried to tell them, this is an investment, your investment for you. You want to make sure that rent comes in. Maybe those people wouldn't pay the rent, you know? You're gonna kick out your brother? So self-dealing, obviously it sounds bad, it is bad. These are transactions. You need to have an arm's length between your IRA and you, and that's why you need to have the custodian. So that you're not, you can direct the funds, you can direct what the investment is, but you're not having direct relations with your IRA, because that's when it becomes taxable, right? When you, for example, it's $3,000 a month rent on the IRA, that rent needs to go to the IRA, not to the IRA owner. Because then that would be a disqualified transaction, a prohibited transaction, because that would be like a distribution. Behind the scene distribution where you take the money that's going to your IRA, you take it personally. That's bad. So that's the self-dealing. That's why we have the arm's length that keeps the tax advantages of the IRA. So I try to tell my clients that these are, you know, tax advantage retirement accounts, and they qualify for tax advantages because you're following the rules that qualify for those advantages. So these are ways to participate. Holding real estate is the #1 asset category. This is where the IRA itself is listed on title of the property. When we go through escrow and it's recorded, then the IRA is shown, and I have a slide that'll show how that looks, but it's the IRA and the IRA's tax number, not your personal social security number. And, you know, when you sell the property, if you want to choose to sell the property, it's always, you know, somebody offers you a lot of money and you say, okay, sell it. There's not any capital gains, there's not any 1031 exchange. The money just goes right back into the IRA for the next round of investing. People really like that part. But that's when it's held on title. So 100%, this would be like a cash deal, $500,000 condo, you have $500,000 in your IRA, and the IRA owns the property. Tenants in common, this is often spouses, 50-50 or whatever the math works out to be, as far as two owners on title. And the other tenant of tenants in common could really be anybody, even yourself. So if you, which is co-investing, not commingling, okay? So you have tenants in common, you have a 50% tenant and a 50% tenant. So that's the way this works. In this situation, if it were me and my IRA, and it was $500,000 at 50-50, then it would be me walking up with $250,000 cash. I'm not going to be able to put a mortgage on 50% ownership of that property that the other half of my IRA showed up with $250,000. So the other tenant also needs to show up with that. Now people get HELOCs on their side of their own personal residence that do show up with the cash that they're partnering with their IRA, and that's fine. But you can't encumber the property on my 50% ownership, right? That wouldn't be, well, the lenders would never get into that. So no one's going to give a mortgage to less than 100%, because if something goes bad, they wouldn't be able to foreclose. And, you know, that's how they say that whether they're going to fund or something. But tenants in common, this could be a HUI as well. You know, there could be multiple tenants in common, as long as it all equals 100% ownership. You know, there are times in my world that property managers are very, very useful. And if you had 3 owners, tenants in common with differing percentages, and the tenant has 1 rent check to write, it better be going to a property manager who's going to then pay all the bills and send the net proceeds back in the correct percentages to those 3 owners. So while you may not legally have to have a property manager, in situations of tenancy in common, it's really helpful. Loaning money, this is a very popular way. Promissory notes, private lending. So the clients choose who they're going to lend it to. They negotiate the terms, the length of time, the amount of interest, the repayment, those details, and it's secured by a property. So on our lending side, we have secured and unsecured promissory notes, right? So the client makes that, they always say, we don't write the promissory note. You might need to have a professional write this, or you might get a template offline, whatever you're the most comfortable with. But they all have the same kinds of details in there, right? This is secured or unsecured. And when there's a security, when it's a secured promissory note, there's typically something of value that is a property. So the collateral part makes them more comfortable. So you might have a niece that needs to borrow $50,000 for her first time home buyer situation that you're going to, she's a non-disqualified person, but you trust your niece, and if she doesn't pay 50,000, well, it's not great, but you still, life goes on. So that could be an unsecured note, right? So clients, whether they have a secured note or an unsecured note, is completely up to them, but obviously secured sounds better. And then investing in an entity, which would be like a HUI, an LLC, for example. Say you had 5 different investors and one of them was an IRA. So at that point, what it shows on our books is that this IRA has a $200,000 investment in this LLC, and it is a 20% owner or whatever the percentage is. So we would show the LLC as the asset, not the property. The LLC would be the asset, and the IRA would be a member of that LLC with its percentages of profits. But this really is very helpful when it is multi-investors in a HUI that are doing maybe a big project, and anything that you see out there that's an investment that you are interested in personally could probably be an asset in an IRA. So the IRS says no life insurance policies because they already have tax advantages, and no collectibles. So collectibles, whether it's alcohol or stamps or whatever it might be, they have a fluctuating valuation. And when it comes to precious metals as an asset in the IRA, it needs to be the value of the metal is the value of the asset. So when you have a collectible coin that's 500 years old, it's worth a lot more than the weight of the gold of that coin. So that cannot be in an IRA. But bullion, that can be in an IRA. It's the purity, its value comes from the weight. You have a lot of clients that like precious metals.
Yeah.
Yes,
Great.
yeah.
Of those 4 options, which one do you see more often in your practice?
All of them, really. It's really a unique, up to the client, and by time they're coming to me to open an account, they already know who's paying what and what the structure is going to be. But I would say the majority are probably one IRA holder buying one property with the IRA. But promissory notes are also very, very popular, right? I know you understand that. They are, this would be much more like you're gonna hold this for 10 years. And this one would be more like you're lending out money multiple times over 10 years.
Depends on the return on investment.
Yes, it does. And that's what they're going to make the decision is, do I want to be a partial owner of this property, a full owner of this property, or do I want to just be a lender on this property with some collateral to make sure that there's a repayment?
Focusing on green and the one below that. the
Yes.
Dark blue. The green in my thinking is you have to consider the commission to the realtor as an expense that increases your investment return, correct?
That is correct. There are expenses, and the IRA pays all the expenses, but gets all the benefits of appreciation and the rental income. But yes, when it comes to a settlement statement in real estate, there's going to be all the backs and forths, who's paying what, and at the bottom, there's, due at escrow. That's what we're going to be funding on, is from the settlement statement. But yes, the real estate commissions are definitely part of the investment. And when somebody is the realtor, they always, I'll take care of this. Like, well, you can't get paid for this. So this is a situation when you're a licensed realtor and it's your IRA buying a property, you cannot get paid commission from that transaction. And that is something that people always like, oh, I hate doing things without getting commissions. That's our bread and butter. I'm like, well, listen, you're gonna get a better deal for your IRA. Your IRA is getting a better deal without your commission on there. And if you don't want to do it, have one of your friends be the realtor on record. I mean, that works a lot in the real estate world,
And if your spouse is the realtor,
right?
that spouse cannot.
Correct, but that spouse could waive that commission, right? There's no commission being paid. The IRA is getting a 3% better deal or whatever it might be.
So there's a benefit having a spouse.
There is a benefit to have a spouse that's a realtor, yes, absolutely. And I have quite a few of those clients out there. They do like that, right? Because they are saving the money, and that money saved is benefiting the IRA by not having the commission. But when you talk to a room of realtors and you say, waive the commission, they're like, we can't do that. You don't have to, but you could have your best friend be the realtor. So this is the titling. We used to have, on the mainland, for example, we use NDTCO for titling. Here, we have been given guidance from land courts about not abbreviating to write everything out. But they've never had a problem with the FBO in the middle, the for the benefit of. So I'm like, well, we can't abbreviate this, so we have. Anyways, so in the big picture, yeah, don't argue with land court. You're getting nowhere with that. Just accept it, right? We all live in that system enough to know. So on the left is the custodian, and in the middle is for the benefit of, and on the right is the client's name IRA. So this is the custodian for the benefit of the IRA. Right, but the client's name is listed. They like that. They like to see that their name is listed on this asset, right? Because if it was just New Direction without their name on it, they'd be like, where's my name on that? What happens if you leave town, right? Those kinds of things. And if it was just the client's name IRA without the custodian on there, then the IRS would be like, no, this is a personal asset. You have to have the custodian for the benefit of, this is the arm's length that gets the tax advantages. So between these choices, we have some clients that want their name on things, other clients that don't want their name on anything, right? They don't want the tenant or whoever to know that they're the ones that own that unit. And then some clients want to put them both on there, and that's fine. So the important part is you don't want to commingle, you don't want to take the first step as the bad step. But people, clients, people in general, when you go to look at an apartment, whatever, a property, let's make an offer. Let's put down some money. Let's get this. That's how you start, right? But earnest money always is part of that, right? So when you don't have earnest money on an offer, it probably is not going to get accepted. It might, but put down some money. That's what the sellers want to see is money. So it needs to come from the IRA. So you can't put in, this is my personal $1,000 and we're going to replace it later. Because then you're having crossover, you're a disqualified person and you're doing a prohibited transaction by putting your own personal funds into an IRA asset. So this happens a lot. I hate it, but there's certain things in life that you get. This one, what do you have to do? You have to get a new contract that's written in the name of the IRA, not in their personal name. You have to tell escrow you're giving that money back to them and we will be replacing that money with a new contract. And realtors, sellers, agents, the last thing that they want to do is do a new contract, even if it's all the same details, but this is the new name at the top. It's pulling teeth. How I have to. Anyways, do it right. Make the offer in the name of the IRA, have the earnest money. So this is where a non-disqualified person can come around. So let's say this property is going fast. And you're going to put in an offer, you're going to put in an offer in the name of the IRA, but your IRA has just been opened and we're transferring funds from Fidelity or wherever it might be. There's not cash in that IRA account to put down the earnest money. And in that time, you ask your best friend, hey, put down $5,000 and my IRA is going to pay you back. And your best friend trusts you and says, here's a $5,000 check, let's make it happen. Because when the money hits into the IRA, or as a line item on the settlement statement at funding at closing, that non-disqualified person is paid back. They're on the escrow line, who put down the earnest money deposit, what's their name? Are they disqualified? No, they're good. Where are we sending the money? Oh, escrow's gonna pay them, we're just gonna, yes. So this is an important step, one that is better to do right the first time, as most things in life are. So we're the authorized signers. When it comes to a real estate transaction, we sign for the IRA and the client signs read and approved on the side. The seller's going to sign here. We don't sign until the IRA account holder signs and says they have read and approved this, then they're instructing us to execute the document. So up until closing, the recorded documents, that's where we sign, right? The client is able to sign on the offer in the name of their IRA. They're able to go back and forth on the different amendments and things that are happening before it's all good, counters and things like that. But when it comes to the escrow signing date, it needs to be the authorized signer, the custodian for the account for that IRA, and the clients will sign that and approved. Right, so you have expenses and you have income. The benefits is the rent. But properties have expenses, right? We all know that. That's why this area is so popular with IRA investors, is because there's new things happening in this neighborhood. Modea down the street, Kuile, Symphony was a very popular, yeah. People like the newness of buying a rental property, right? There's not going to be a lot of assessments that come out of the blue. You buy an older building, you get a better price, but is it going to be better in the long run? There's a lot of new construction in Kaka'ako and all over. And we have a lot of clients with investment properties in them, even though they seem to be more expensive in the start, but they get higher rents. And it's also very, when you buy pre-construction, friends and family rate pre-construction, it's typically going to be a better price than it would be when the condo is brand new and they're being sold existing. So if you have $1 million condo and you have a 20% down payment, but it's not going to be finished for 3 years, that's a typical scenario. So you're putting in $200,000 to the developer, and the remaining 8 is going to be coming in the next 3 years. So at that point, they need to show proof of funds that, hey, I do have $1 million in my qualified retirement plan, but at this point, I only need to put in 200,000. And then by the time it's built, well, maybe it's $1.2 million. And then the client has the choice of, well, do we just sell this when it's built? Take the profit, no capital gains, no 1031 exchange? Or do we rent it for high rent because it's a brand new building and everybody wants to live in it? Or if they all make their own minds up when it comes to that. And sometimes, and they don't have to make it up until later anyways, right? So they have 3 years to make that decision while it's being built. They put down their deposit, everything is cool. There's not any rental coming in, but there's not any maintenance fees yet either because it hasn't been built. So expenses, income. People always say, well, what happens when the roof flies off and needs a new roof, right? So all these roofs are always flying off apparently in people's worried minds. But obviously there's homeowners insurance covers roofs, there's not, I always say, what would you do if it was your personal property? You would have some insurance on that, right? Yeah, but I can only contribute new money to X amount. I'm like, well, if you have a SEP, you could contribute up to 25% or $69,000. That could cover some expenses on things. But typically there's going to be a tenant with a rental income coming in, and that rental income is going to cover expenses. Or maybe you still have an old 401k that you could roll over some more funds that's already in retirement qualified accounts. But that is the way it works. But there's not typically the mortgage, right? There's no mortgage here, so it is a cash cow. Any rent that's coming in is most likely covering the insurance bill, and tenants pay some of the bills, but not all of the bills. But this is what the client crunches these numbers, right? Okay, so we're going to be building up from the income to cover future expenses or other investments. So this is our fee schedule abbreviated version. It's $30 to open an account, $250 on a transaction when we don't take commissions, so we are a fee-based company. So people, I don't like fees. Well, if you know upfront what the fee is, we're not any secretly taking commissions off of things that you didn't know we were doing. We are upfront about it. So when you have a transaction, you ask us to do something, you ask us to buy something for your IRA, we charge a transaction fee of $250. Our annual administration fee is $390 per asset, and we have a $30 wiring fee. These are basically, we don't have a per check fee if you need to have checks coming out of your IRA, say you have a contractor that needs to come in and do some work on the property and he wants to get paid, of course. Our portal is very easy to just say, pay the contractor, this is the amount, this is his name, here's an invoice, upload it, and the check goes out the next business day, and there's not a check fee for that. So clients like that they can pay their bills accordingly, easily. Or if there's a property manager, the property manager can pay the contractor, hold it out of the income rent and send the net back. There's always benefits to property managers and negative sides. They take a fee that's coming out of your profit, but sometimes they do a lot of work for you, they're worth it. Sometimes people think they can do it for a while, and then after a few years, they're like, we don't want to micromanage our retirement account with being a property manager that's not paid for this condo anymore. Let's get a property manager. And then they pay their fee, but the stress goes away. There's not any 3 a.m. call about something broke. There's a property manager. I think that. Yes, okay. Are there questions?
For the people on Zoom,
Yes.
you can put your questions in the Q&A box. And then we'll read it out loud for everyone here in the audience and on Zoom as well. But do we have any we'll open up questions on the floor first while we wait for the Zoom questions.
Yes, Natalie.
So your company is just a custodian
That's correct.
holding,
Assets in retirement accounts.
but you don't manage, right?
Yeah. We are not the property managers.
Okay,
So for example, if you have a condo and the rent comes in, and then we let you know, hey, the rent came in, there's a notification that goes out. But if the rent doesn't come in, we don't notify you because we're only letting you know that money came into your account. Right? So if you're expecting there to be some money coming in and it's not coming in, then you need to contact the tenant or the property manager.
you do hold an account
Yes,
for the IRA.
that's correct. The IRA is the account.
You're holding the account. to
That's correct.
receive Money. Do you also, you mentioned about paying expenses.
We do, because the expenses of assets held in the IRA need to be paid by the IRA. And the IRA payments could be often homeowners insurance, for example, it comes in twice a year, 4 times a year, whatever it might be. But that homeowners insurance policy needs to be paid from IRA funds. Now, they could easily be paid from the rental income that's going to the property manager, and the property manager could pay the insurance bill. And then, we try to, if there's a property manager, we try to get them to pay as much of the bills, so there's less money going out of the IRA. It's okay if it's coming out of the rental income, that's still IRA money. That's the assets paying back to the IRA.
Going back to your first slide.
Yes.
You said the account holder cannot get paid to manage,
That's correct.
but they can manage and not.
There are
get
many
paid.
things that you can do as the account holder that's not sweat equity or getting paid, right? You can still be the one that chooses the tenant and the amount of the rent and the color of the walls and all of those details. There's a lot of choices with the self-directed IRA that's investing in real estate. You get to choose which one you purchase, you get to choose what color the paint is, who the landscaper is going to be, but all of those things are going to be associated with income expenses from the property that are paid by rental income.
Yeah, my focus is on the management.
Yes.
Once you bought the property, you already determined you rented it out. My question is, as a holder of the account, IRA account, I cannot get paid managing it,
That's
but
correct.
I can still manage it.
That is correct. There are many things that you can do
So if what do I?
to be
tell
the unofficial unpaid property manager, right?
What do I tell the tenant to cut the check to? So
We
I can
have
do
The check is going to the IRA, but you know, the world gets better sometimes. So instead of check in the mail, where's the tenant's check in the mail? You can just have an ACH account and the client does it right online and it's from their checking account to your IRA account and you get notification that the rent was paid today. Hey, there's some money dropped into your account. That's great. And there's no check in the mail issue, right? You know exactly when that tenant paid their rent. It can even be set up that we're pulling the funds from the tenant. There's a property manager situation here. He's in the Navy and he's in a submarine and he wants, the money comes from the Navy into this account. It's a $4,000 a month rental property in Kaneohe that's perfect for a military family. And we draw his rental income because he has allowed us to be able to do that. So he doesn't ever have to worry about, did we pay the rent check? Was the rent paid? I'm in a submarine hidden in the world and, I want to make sure my wife and kids have a roof over their heads.
So if, I'm assuming there's no separate property manager.
Yeah.
And the owner is managing it
Yeah.
unpaid.
Yeah.
Because money has to go straight directly to the IRA.
Yes.
Expenses, there's no management.
Right.
So you guys will have to do more work.
We don't do more work, the client does it online. So the client's gonna log into their account. They know what expenses are there, right? There's
So-
homeowners insurance, there's a HOA, and you have recurring bill. Sometimes bills change, right? Like an electric bill. Say the tenant didn't pay the electricity and the IRA needs to be paid. Well, that's a different bill every month, right? Coming from the electric company. It's not just set $400, So the tenant, the IRA holder logs into the account, has the bill, says send Hiko this bill, and it goes out the next business day. And they have done their work, not paid, but they have gotten that bill paid from IRA money. And, some clients don't wanna be bothered. And some clients are like, hey, that's my profit margin. I will do it. I will make sure those bills get paid every month. It's not a problem. It takes me 5-10 minutes to do it. But some clients are, I'm already old and retired and I'm not doing anything all day. I got all the time in the world to log in and make sure that that bill is paid. Yeah.
Yeah, I have two questions.
Yeah. Okay,
Oh.
yeah, so I'll read the first one on
Okay.
top. So I buy property at foreclosure auctions. How is it possible to withdraw 10% from the IRA account to bid? But if I don't win, to redeposit the funds, what is the solution?
This is a fun one. We have quite a few clients that are a little interested, over addicted, you know what I mean, of auctions. So in that situation, and this is also, it's through the portal. We say, what is your maximum bid? Okay, there's gonna be an auction, you send us information about the auction, and you're going to need to have a cashier's check. So if you don't win the bid, you're gonna send that cashier's check back to your IRA, and we're gonna redeposit it. If you do win the bid, it's typically like a 10% down, and the next payment is the rest of the 90. So it's really, that's how we handle it. It can be done. It takes a little cashier's check and a FedEx to get it to them in time, and there's not always that much advance notice on. It's always Hilo, I have to tell you, it's Hilo land auctions in Hilo are very, very popular. But they are like on the courthouse steps and they happen and, have a client that I think he's gonna buy every lot on his cul-de-sac, he's got his primary residence, but IRA, and he gets them from land auctions. And, we always wish, it's a little bit exciting, right? It's like going to Vegas type of situation. Oh, I won. I got it. Got me some really exciting, but that is how foreclosure auctions happen, and it's really not that difficult. It's just a couple of steps in there as far as getting a physical check, because the IRA account holder cannot use his personal or her personal check for that auction, right? It needs to be IRA money, and they want an actual check, a cashier's check for those. So we do send it.
All right, next question on Zoom. If there isn't enough assets in one single retirement account to purchase the property, how would you use funds to separate IRAs? For example, SEP and a regular IRA.
So I went over that is but basically tenants in common, right? It is possible to get a non-recourse loan, a mortgage. So it's not usually on the 101 class, but I will just say that it is possible for an IRA to get a mortgage. That is always better when it's just a cash deal, right? Cash is so easy, but when people look at real estate, they usually finance their homes, right? People buy real estate, they're financing it, they're getting a mortgage. With the IRA, it's mostly cash. There are some clients that crunch numbers and decide that getting a non-recourse loan works for them. What that looks like is the IRA is the borrower, and the non-recourse lender are not many around here, as in they say they do. I will say Central Pacific Bank has been good as far as commercial properties, but like if you want to buy a 3-story Moili walk up the whole property, you could probably get a mortgage for that one with the IRA. But if you wanted to buy one single condo unit, they're not going to lend on that. But there are mainland lenders that are qualified to do that in all 50 states. The reason that the mortgage issue is unrelated business income tax, UBIT. So what happens when the qualified retirement account has $1 million and it buys $1 million property for cash, there's not any unrelated business income tax. But when you have $1 million in an IRA and you get a non-recourse loan, the IRA gets a non-recourse loan for $1 million and you buy a $2 million property, some of the net proceeds, the profit, is coming from outside money. It's not qualified money, it's the mortgage. So when you make a profit on the mortgage portion, that is taxable. So then you have to file a 990T, and you have to find a CPA that can file a 990T for an IRA. And the tax payments is coming from the IRA. So sometimes bigger's not better. Being neutral, I try to not tell my clients what to do, of course, but sometimes it's better just to buy with the money that you have in the IRA instead of getting outside money that's going to be partially taxable, that your IRA, there's going to be more paperwork now as that mortgage gets paid off. So long story short, cash is easy, mortgage could happen, but there are taxable consequences when you take borrowing outside non-qualified money and putting it into a qualified retirement account investment. But if you have a husband and a wife and they each have an IRA and they want to go in 75-25 or 50-50, whatever it might be, that's totally fine and very normal. Because there's never enough money. We all know that, right? The $4 million IRA is looking at a $5 million property. That's just the way life is. So try to keep it with what you have. You'll be happier, or do some really good number crunching if you're thinking about getting financing.
All right, question.
Yes.
And how does it work at RMD? And all your IRA owns is real estate.
Right. So that's the fact of life. The other fact is they keep bumping up the minimum age, right? So that's always good. We're looking at 73, could be 75 in the next few years. And that's always a blessing for people that are approaching RMD, right? Because there is a time where you haven't paid the taxes. It's been deferred for 30 years. And when you're retired and you start taking distributions, that's the taxable transaction, right? So that's always a question. And there are multiple choices and there's always an answer, just so you know. May not be the answer that they want, but they're never without an answer. So what happens is, let's say it's $1 million IRA and it owns $1 million property. But they have no more mutual funds and other IRAs, right? Because the RMD is calculated from all of your tax deferred retirement accounts, right? So it's not just this one has $1 million and this one has this much, and then you have to take this much for that one. No, it's the bottom line, that's the number, and you can choose what you want, how to pay that. So I often tell the clients, look, go back to Schwab, wherever they might be, sell some underperforming mutual funds and take your RMDs out of mutual funds that you have over here. Or I always say, sell the property, and they're like, I don't want to sell the property. Wait, no, I'm not telling you to sell the property, but that is, you could change that $1 million property into $1 million cash and you'd have all the money in the world to take your RMDs for as long as you want. Oh no, that's not what I want to do. So it's very rare that you have a client that has all of their eggs in one basket, right? They have a $1 million property in their IRA and they don't have anything else anywhere else. That doesn't exist. But if it were, what do they do? Well, the rental income is coming in every month and there's no mortgage on that. The rental income is cash and assets. The rental income is building up their cash. So that's another easy option. I have a $10,000 RMD. Hey, guess what? I made more than that in the IRA rental income this year. Let's take out $10,000 and go spend it, right? Because the government says you have to. What do you do if you don't have enough rental income? You can't contribute anymore. You don't have any mutual funds over there, and you just have this property and you have to take out money that's not in there. That's the worrisome question. So the answer to that is in-kind distribution. So you have $1 million property that's owned by the IRA. You have to take out X amount every year. Well, if you don't really want to sell it and you have no other way to pay the RMD, you can do value. You can take a sliver off of the title and call that your RMD this year. And sometimes the clients want to do that. Sometimes they want to take off 20% over a 5-year period. And at the end, the IRA owns 0. They personally owned that property 100%, and they only had to pay taxes over 5 years for the 20% in-kind distribution. And then we're down at the title company signing over the quitclaim deed to change that their attorney made for them, you know. But that's always the answer, right? Those are the scenarios, and that's always the question that people with a lot of money and are getting up in age are always like, hey, what about the RMDs?
So do you need to get an appraisal every year that you do that?
No, you don't have to get an appraisal every single year. And you know that there are short form appraisals and long form appraisals in the world. Well, the short form appraisal is completely a legal document, right? So you're not, the long form appraisal in my experience is when you're financing your house. The lender is going to make sure that that house is really worth that, right? So then you need a long form appraisal. But when you're doing an RMD or a Roth conversion of the property from traditional into Roth, and you need a set fixed value, then we can use that appraisal, short form appraisal, and we can use it for 3 years. So it's
3 years.
it's not a big expense, but it's a lot less, but it's important to tell the clients, hey, there will need to be an appraisal before they get into RMD. When they're still working, they're not forced to take an RMD, then we still need an annual fair market valuation, the FMV. Now, when you have mutual funds in your IRA, the FMV is December 31st of the last trading day of the year. That's what the account is worth, because that's what the securities are worth on the trading floor that day. So when it comes to the IRS, they still want to have an annual FMV. You know, like I said, it's just a different asset in an IRA. It's still a qualified plan, but you'd have to have a valuation. So at that point, we need to have the client tell us how much it's worth and what are the backup documentations. So usually that is the realtor that sold them the property is going to write up a market valuation. This house is worth that. Here's the comps down the street to show that. And it gives the realtor another opportunity to talk to their client again about, hey, this is what it's worth. It's always up to the client, but there is the county assessed property tax valuation, right? So those things are never accurate, but it's a legal document that says that house on that street at that address is worth this according to the county. Here's a government document. Well, that works too, so. Fair market valuations before RMDs are more like place setters, it's not. Doesn't have to be the appraisal, because you're not being forced to take the RMD. Once you get into RMD, things are a little bit more serious when it comes to the valuation. And that fair market valuation is important, but it's not going to be determining your RMD at this age. Yes.
So once you do the RMD, you own part of that property.
Yeah.
Does that mean disqualify people who now use it?
Not until it's 100% out of the IRA. But yes, that is the goal for many. It is. But it also makes it more challenging and more of a reason to have a property manager. Because then you do have two owners. You have the IRA that owns 90% and you personally own 10%. And that 10% is going to be your income tax for the year. It's going to come into your pocket. You're going to pay taxes on the profit of that 10%. Yes, go.
So one owner.
Yeah.
Person gets the property, brings a hammer, whatever, or does some plumbing work. Does the property repair, whatever. Okay, is that a prohibited transaction?
Yes.
Okay.
So this is kind of we don't like to say gray areas because the IRS says they don't have gray areas, but of improving the value of the asset by sweat equity, picking up the hammer.
Sweeping.
Right, so the room is green walls today, tomorrow it's white walls, and nobody asked for the reimbursement of a gallon of paint. But if on title it shows it's a 3-bedroom house and now it's a 5-bedroom house, there better be some money that was paid by the IRA to put those 2 extra bedrooms on there, right? You still get to choose the contractor, but you can't pick up the hammer. So that's the difference between improving the value of an asset by sweat equity. And there's a lot of clients that are handy with hammers that just think like, I want to do this. I do this all the time. Like, I'm sure you have a brother or a best friend in the business that you could get a good deal on the improvement of this property, but don't be the one.
Second question, you mentioned Modea.
Yeah, it's
What-
just
what-
around
why
here.
Is Modea one of those things that people have been using their self-directed?
Well, it's a new project, right? So we've been working, we work on any project that they want us to work on as far as being neutral, but it's nice to have people that are coming in to look at a property, and nice to know that you could also buy one of these units with your IRA. So
It has to work, the numbers have to work.
the numbers have to work, absolutely. But it would typically be Huile Place, for example, or Dayton, Piolani. There are clients, there are individuals that have purchased pre-construction there that found that they could also buy a unit as a rental property in the same building. Well, then they have eyes on the property. They feel more comfortable. They're like, yes, I have $1 million property that's going to be mine to live in, and I have $1 million property that we're going to rent through the IRA. They're going to get really nice rental income, and it's in the same building. And they like that. The lights are on, the tenant's paying the rent, but Modea, I've spoken with their group and they have a very interesting product. It's interesting to me. I mean, it's not for everybody, but it is for rental property. It's very interesting. And right now they have the whole floor is open with no walls inside. So if you're on one side, you can see all the way to the ocean or all the way. It's just an incredible space. You don't rarely get that opportunity to see something with no interior walls. Yes, I'm sorry.
No. Thank you, Dan, for.
Thank you
being
so
here
much
this
for
afternoon.
having me.
And definitely, there's a lot of information you've given us. Fortunately, it's been recorded, and so it will be uploaded on YouTube on our Senior Counsel Division channel. So if you have any questions for Dan later on, his information has been provided, and you can rewatch his video. I'll need to rewatch it multiple times to understand it in slow motion. But anyways, thank you very much for your time
It's
today.
been my pleasure. Thank you for having me. And I would just like to say that attorneys are very important in our world when we refer them back to things. You know, the clients are like, what about this? I said, that's a legal question. Why don't you go talk to your attorney about it? And it's nice to have that other side be there. Because it's needed, because I'm not an attorney and I'm not pretending to be an attorney. And sometimes there are legal questions in the world that you need an attorney for, and I'm sure that's why you all have businesses. But when it comes to IRAs, we send a lot of our clients back to their attorneys to figure it out, or to their CPAs, because it could be taxable with something they might want to do.
Thank you.
Thank you. All right, thank you, everyone. Have a great day, and then we'll be back with another coffee hour on July 11th. So thank you again.